There's no doubt inflation is problematic for people that are going to retire. It can be problematic, period, but especially for people that are already retired or they're trying to plan for retirement. And that's because they're planning on having a certain amount of money to live or income to live for the rest of their lives. And when they can buy less with that same amount of money, then, well, that's hugely, hugely problematic because, well, they won't have enough money to retire in the way that they thought they could retire. So in this video, I'm going to share with you how inflation affects retirement. And in the end, I'm going to share what you can do about that, because I think there are solutions for just about everything in every financial planning, retirement planning scenario if we just keep an open mind and we really, really look at the numbers and the math and we look at history and we think about what we can do and we really embrace and own our own financial journey. So that's what I'm going to share with you in this video. Hi, I'm Camille Gaines here, and on my website, Retire Certain, I share information that helps proactive investors use their assets to live the life that they want. Assets may be a great stock portfolio, or it may be some real estate, or it may be some ownership in a business or an online business, or usually it's a combination of those different things. And that's what this channel is about. Now, the very first thing I want to share with you is how inflation affects our retirement planning, because the best laid plans can be blown with inflation. It seems like no big deal, or it was no big deal when inflation was about 2%. Historically, though, on average, inflation has been about 3% a year. So this means the year you retire, the next year you've got to have more money to buy the same amount of things or pay the same expenses that you paid in that first year that you retired. That's how retirement planning is done traditionally. I use a little bit different method, but I like to pull in that traditional retirement method. And we sort of just combine things and make things work based on what an individual wants. All right, so the first thing to consider and way that inflation affects retirement is, like I mentioned already, in your expenses. So I want to give you a resource. Let me look at my notes, and I'll put it in the links as well. And it's a website called in2013dollars.com. And at $2013, and I'll try to remember to put that in the video as well, you can put in how much your expenses are right now, and then you can put in how much your expenses will be when you're in retirement. If you're already retired, you can look out 10 years. If you're planning on retiring in 20 years and you think your expenses are going to stay the same, although that's a bit far out. Let's say if you're planning on retiring in 10 years, then you can put in your current expenses, and let's just say you think they'll be about the same in 10 years. It will show you how much your expenses will be just based on inflation. Now, let me give you an example. Let me glance at my notes on this. So say you're spending $12,000 a month now on your expenses. I know, again, that'll be high for some people, really low for others. That's not what this is about. All right. In 10 years, that will be $16,127. So in other words, you can buy $12,000 worth of goods and services now, but in 10 years, those same $12,000 worth of goods and services will cost $16,127. And that's if we plan on or use about 3% for our inflation estimate. Okay, we don't know what inflation is going to be. Inflation, again, historically has been about 3%, but in 1980, it went as high as 13.55%, which is crazy. Can you imagine being retired and planning on, maybe that 3%, and it goes over 13%? You're almost doomed. So there are some solutions. Again, they're at the end of the video. So that's the first thing, is how that affects your expenses. Inflation, it affects your expenses because it eats the purchasing power of your money. On an annual basis, let's take that $12,000 a month, and that would be about $144,000 a year. In 10 years, that is $193,524. So if you were planning on that $144,000 living a year, you're saying, well, that's about what we spend. just due to inflation, in 10 years, that's going to be about that 193,000 number I gave you. So that's really, really big. These aren't nickels and dimes we're talking about. It's not going to help to cut out lattes, which is, as you know, if you watch my videos, my least favorite financial advice for retirement. All right, the next way that inflation affects your retirement planning is that while Social Security is adjusted for inflation, it doesn't always keep pace with inflation. So it's not adjusted as much as actual cost, and it also is slow. So we can't count on Social Security to completely address the inflation issues. Not only that, I'm not a Social Security expert. I'm not collecting Social Security yet, but there is something I want to make sure I mention. I have in my notes over here, and that is that Social Security is adjusted for inflation, but apparently Medicare Part B premiums are tied to the retiree's income. So that's going to also affect the amount that you get from Social Security, and that is how, or another way, that inflation affects negatively, unfortunately, they're all negative, your retirement plan. The third way that inflation negatively affects your retirement planning is that, I touched on this a second ago, the amount that you withdraw from your retirement account to live based on traditional retirement planning will increase every year. Now, let me tell you what I mean by that. So you may have heard me talk about this a bit more here. Traditional retirement, or you may already know, is based on you withdrawing a little bit of your investment savings every single year so that you can pay your bills. Studies have been done about how much it's safe to withdraw, but 4% became the popular rule of thumb. The 4% rule was developed by someone named William Bingham back in the 1990s, and that's kind of stuck around as the number to use. Been lots of updates since then. The reality is that whether or not the 4% works completely depends on what happens with investment returns, which is related to really market cycles and stock market performance during the study period. I've done another video on that, but without getting into all that, just trust me, the 4% rule is kind of the standard rule of thumb, and I hate rules of thumb, but it's the rule of thumb for people that are counting on a more traditional retirement. They're saying, okay, I'm going to withdraw about 4% of my retirement savings in order to pay my bills in retirement. All right, so that very, very first year, as I mentioned, it will be 4%. But then after that, it's got to be increased every single year for inflation. Cumulatively, just think how huge that is. Even if you just do really simple math and you don't compound that, and you say, okay, well, if inflation just is about 3% a year on average, and I'm retired for 10 years, which I think everyone is pretty much hoping for, planning to live 10 years in retirement, then that's a pretty big increase right there. So we can see how much this will impact the amount of money you need to originally have saved in order to last in retirement, because you're increasing every year the amount that you need to pay your bills just to break even. And it starts at 4% if you're using that standard rule, but then it increases every year after that. Now, I said that I would share solutions. Those are 3 really big ways that we're impacted by inflation in retirement. One of the things I like to point out in my work is that there's so many things that are outside our control with all of this, with investment returns, of course with our longevity of our life, although we can really influence that with our health and our exercise and things like that. But with our investment returns, with things like inflation, there's just not much, we can't do anything about that, period, okay? But there are some things we can do with our investment choices that can help us protect ourselves against inflation. One is to simply own investments that will increase in value with inflation. An example of that is real estate. Another example is TIP ETFs. Another example might be something else that you own that the price increases along with inflation. Stocks increase with inflation. I've done a video on an online business I recently purchased. I expect that it will increase in value with inflation. So think about which one of my assets will increase with inflation. Bonds are hurt by inflation. The next way that you can protect yourself from inflation in retirement is by having income that increases with retirement. Bond income is often fixed. There are other types of investments that have fixed income. So investors can run into real trouble with this. Retirees can run into trouble with this. If inflation goes up too much, that's scary. They can end up with what's called a negative real return. So it's that return, say you've got 3% on a fixed bond and inflation is 4%, you've got negative income. That's called negative real income. There are things or income streams that increase with inflation. That could be anything like consulting income, a little bit of consulting you get going after you're in retirement, that type of thing. Various side hustles, maybe you offer your services on something like Upwork for a little extra income. Something like real estate rentals, the income from that increases with inflation. So there are ways that you can protect yourself from inflation in retirement. That's what I wanted to share with you in this video. And remember, above all, retire certain.